There is still healthy demand for property in the market. In July, we had our highest listings market since July 2015. In June, it was highest since 2013. We saw highest audience levels in July since March, and we sent out 2 million buyer inquiries to our customers in July. So the demand for property is still there, and yes, there are fewer buyers than this time last year, but I think the supply-demand equation is back in balance. And there are some really strong fundamentals that we think will underpin that demand for property. The first is record unemployment, which we all know is the lowest since about 1974. Household savings are still very strong, and we're going to see increasing immigration come through. All of those things will underpin demand. And then, of course, there's the rental market. We're seeing very low rental vacancies and double-digit rent increases across many markets in the country. That, coupled with falling house prices, is inevitably going to bring investors back to the market.
We know that the RBA is currently in a tightening cycle with respect to rates. Is there a risk that it'll tighten too quickly, in your opinion, and potentially bring the property market undone?
Look, I would think the RBA know what they're doing. I'd like to think they do. I think we will see smaller increases than we've seen in the past months as they let the impact of those flow through. Our view is that they are doing it sensibly. It needed to happen. We've got to get inflation under control. We're not forecasting massive drops in house prices over the next 12 months. We're looking at about 5 to 10%. And it's important to put that in context because we've had significant rises in house prices over the last 2 years. If we have a 5% drop in house prices from here, that really only takes us back to August last year. And a 10% drop in house prices would take us back to about May last year. So it's really just kind of knocking the froth off the market that we've seen in the past 12 months.
Are you confident that households are going to be able to repay debts if the cash rate reaches either 3 or in excess of 3%? You touched on before that you felt confident about household savings, but what if the cash rate goes to 3 or beyond?
Well, what's happened in the last 2 years is that everyone who's got a loan from any lender in the past 2 years has had 5% interest rate as the rate that they've got to be able to service at. And so consumers should be able to service mortgage rates up to 5%. You're right, beyond that, that might become a stretch, but they have record levels of household savings, particularly in mortgage offset accounts, which should buffer against that, coupled with low unemployment. And I think everybody is forecasting wage increases to start to flow through in the coming 12 months again, which should cushion most consumers from rate rises. So
how is the business being impacted by the tight labour market, and how is it handling wages and any wage cost pressures?
We've definitely seen, particularly in our sector, the tech sector, strong competition for talent and wage growth in excess of what's been happening in the economy in our sector over the past probably 2 or 3 years. We've already locked in our wage increases for 2023, and we've locked that in below the level of inflation. And what we have seen in the past 2 to 3 months is a softening in that demand in our space. And we are seeing what we're calling a flight to quality. As talent in the market has decided to move towards more quality places to work, as funding dries up for some of the startups in the economy.
Finally, Owen, what is the outlook for REA Group?
Well, we believe we've got a strategy that is going to deliver continued growth. We put new products into the market in the current financial year, which will deliver growth into FY23 and beyond. And we've guided the market for the new financial year, FY23, that we will have double-digit yield growth in our products and double-digit revenue growth. So we're very excited about 23, albeit it is going to be in a much more subdued property market.
Owen Wilson, it's been great talking to you. Thank you for your time.
Thanks, Catherine.